Finance. We usually get very excited on hearing this term, right? But have you ever wondered how big this term is? This term is so big in itself that it has an entire world of its own called as financial markets. In this video we will go through an entire landscape of financial markets. We all want to grow our money by investing it somewhere or the other. But due to a lack of an overall understanding of financial markets, we tend to follow a herd mentality and end up choosing most common options for investment, such as bank deposits, government schemes, real estate, etc. With the help of this video, you will not only know various options for investment in future, but can also assess your current investments with an overview of entire financial markets. So let's get started by understanding what exactly is financial market. Just like we go to vegetable market for buying vegetables, supermarket for buying groceries for our daily life, similarly, a place where we buy any kind of financial instrument, such as gold, bonds or stocks, is called as financial market. In simple words, financial market is a platform for buying or selling any financial instrument. It has different types of participants in it. These participants are common people, banks, government institutions, corporations. All of these, who participate on exchange of any financial instrument, are called as financial participants. You can now imagine that financial markets are the backbone of any country and its economy. Since all major institutions, government, and we as a common people, are all directly linked to it some or the other way. Therefore, financial markets represents economic stability and health of a country. It provides valuable information on assessing future prospects of a country. In simple terms, we can say that stable financial markets represent stable economy. Now a question rises that why do people even participate in financial markets? In this financial market, each participant has its own purpose of participating. If we talk about large corporations, their main purpose is to raise capital for the growth of their company. For example, companies like Apple and Netflix have raised a lot of money from the market and invested it in their business. In simple words, more capital a company has, more they will invest in their company, and it will result into better growth for a company in the future. Whereas if we talk about government institutions, their main purpose is to finance public projects. Government has limited source of generating money, hence it's not sufficient to fund all public projects just by it. Therefore, government often raises money from financial markets for funding public projects like building expressway or improving public transportation for better connectivity. In simple words, more capital government has, they will invest more on building infrastructure, which in turn will result into better economy. Till now we have just discussed about a participant who wanted to raise capital, be it either government or corporations. But who is actually funding this money? Well, they are our third participant of financial market. They are called investors. Investors can be a common people like you and me, banks, private firms, foreign institutions, etc. Main purpose of investors is to invest their savings in order to grow their money. So what do you say? Isn't it a perfect match, where one party needs money, whereas another want to invest their money? Therefore, financial market is a platform that facilitate these transactions, where each participant gets a perfect opportunity to fulfill his desires. Financial markets is actually a combination of different types of markets, hence financial markets can be broadly classified into 6 categories. Let's go through each of them one by one. First one is bond market. Bond market is a platform where exchange of any type of debt securities like bonds takes place. Bond is nothing but a paper instrument, which investors buy for a fixed interest just like bank deposits. Government or corporations issue these bonds in order to raise capital, whereas bondholders get fixed interest every year till the bond maturity, and their principal amount back at maturity. Bonds are of different maturities, it ranges from 3 months to 30 years. Under normal conditions, higher the maturity, a better interest rate bond offers. There are 2 types of bonds. The bonds issued by companies are called corporate bonds, whereas bonds issued by the government are called government bonds. Most of the time you get better interest in bonds than bank deposits, hence investors prefer these for safe investment. Next category is that of a stock market. Yes, everyone's favorite, stock market. Stock market is a platform where companies gives a stake in their company, in a form of shares of their company, instead of issuing bonds in order to raise capital. Investors buy these shares to get returns from an increase in the share prices, along with the growth of a company in the future. Note here is that there is no fixed return as such, but the returns of investors actually depends on the performance of the company. If company grows, then the money of the investors will grow as well. Stock market has two subcategories within it: primary market and secondary market. Example, what we saw here was of primary market. In the primary market, investors directly subscribe to the shares issued by a company itself, hence we also call it as an initial public offering. Which means that the company is getting newly listed in the stock market, and investors deal directly with the company to subscribe to its share. Whereas if we talk about a secondary market, shares of already listed thousands of companies like Microsoft, Apple or Google are traded on stock exchange. In a stock exchange, investors exchange shares with other shareholders, instead of dealing directly with the company itself. Investors, in the form of bull and bear, keeps fighting for price movements in exchange of these shares based on market sentiments. Price of shares fluctuates based on the company's performance, economic factors, supply-demand, trading activity. Hence a risk and return both are high in this market. Stock market is a very big market in itself, but in the world of financial markets it is just a small piece of the cake. Coming to our third category, which is commodities market. In this market, physical good commodities, such as gold, steel or wheat, exchange hands between investors. Most of business needs some or the other raw material to make their product. For example, any car company like Tesla needs a raw material like iron or steel to make a car. Therefore, Tesla becomes a net buyers of these commodities. Whereas companies like POSCO are net supplier of these commodities, since their business is to sell these commodities. In a similar way, government needs commodities like wheat, energy or oil to meet the daily needs of the country. The prices of these commodities keeps fluctuating according to the global supply-demand. These instruments are also traded in a digital form, hence causing institutions and individual investors also to participate in it, to take advantage of the price movements. Gold or silver, which we buy as a safe investment, actually belongs to this category of financial markets. Next category is that of a Forex market. Forex market is a platform where exchange of currency pairs takes place. The main purpose of this market is to incorporate global trade like import and export. For example, we all know that Infosys is an Indian IT company, which provides IT services, but most of their clients are from United States and Europe. So on completion of any project, when client makes a payment to company like Infosys, they do a payment in US dollars, which can then be converted to local currency by the company through this Forex market. This way thousands of companies are able to do business in a global landscape. Apart from this, Forex market is also used by investors to hedge their foreign investments from currency risk. This is done via currency pair contracts. You will also be surprised to know that among the overall financial markets, this is the most liquid or the most traded market. Where in the stock market, up to $191 billion worth of contract are traded every day. In the Forex market, number is approximately $5 to $6 trillion worth of trade every day. After this comes one of the most famous, real estate market. It is a market where exchange of physical properties, such as agricultural land, commercial properties, or residential houses, takes place. Each one of us want to have house of our own some day or the other. That is why it is an emotional decision for many of us. Whereas people also look at it as an investment option, because in history we have seen that the prices of houses or land generally go up, due to limited supply, and they are one of the real hard asset on planet. But there are two major problems in this market. The first problem is a requirement of a very large capital as a down payment. House or land costs so much that for most of us, it would be the most expensive asset of our life. Whereas second problem mostly tied with the first one is that of a liquidity. Due to such high prices of properties, it's not easy to find buyers and sellers as easily as in other financial markets. If we talk only about buying real estate for investment purpose, there is actually a solution to both of the above problems. There is an instrument in the real estate market, called as REITs. It means Real Estate Infrastructure Trust. Idea of REITs is very much similar to that of mutual funds. With the help of this instrument, you don't need to actually buy the entire house or shop in order to invest in it. Actual properties like malls, office spaces or apartments etc. will be owned by REITs companies. Whereas investors like you and me can actually buy units in the form of REITs just like mutual fund units. This way we can be a partial owner of those real estate based on units we hold. Other benefit of this investment is that a rent from these properties will be distributed among all the REITs holders, and value of REITs units will also grow as per development in the real estate prices. Isn't it simply amazing? With this, let's touch base on the last category of financial markets, which is derivatives market. Financial contracts which doesn't have a value of its own, but whose value is instead derived from an underlying asset gets traded under derivatives market. Its main instruments are futures and options. Main application of derivatives instrument is to be used for hedging. Let us understand futures contract with an example. Assume that there is a farmer who cultivates wheat and the price of wheat in the market is $300 per metric ton today, but his wheat crop will get ready after 3 months. This raises a question to the farmer. What if prices of the wheat falls in 3 months? Whereas a buyer of wheat feels that the price may rise in 3 months' time. Hence, in order to avoid the fluctuations in the price of wheat, both of the concerned parties sign a future contract, which says that after 3 months from today, a buyer is obliged to X amount of wheat from the farmer at the rate of $300 per metric ton only, irrespective of what is the price of the wheat at that time. This solved a dilemma both of the parties were in. This contract is nothing but a future contract, and people use it to hedge against price fluctuations of their underlying asset. In our example, underlying asset was wheat, which is a commodity, but the same concept is applicable on other financial instruments as well. Whereas if we talk about options contract, then this instrument is like an insurance. We will understand it with an example as well. Assume that you have 100 shares of Apple, what you had bought at the price of $100 a share. And let's say a price of it today is $160. Hence your net profit today is $6,000. But due to various reasons, you feel that the market can fall any time now, and you will lose all of your profit. Still, you do not want to sell your shares, since you took it for long term. Then you can actually take an option contract, premium of which will be around $600 in this example. With the help of this contract, you will be able to secure your profit in the market downturn. Let's see how. Assume that after 2 to 3 months of taking this contract, Apple shares fell down to $100, but due to this contract you will still have an option to sell your shares at a price $160 instead. That's why it's called an option contract. Whereas if price of Apple shares would have gone up to, let's say, $200 per share, then your profit on your actual shares will rise, but that premium amount of $600 what you paid to this option contract will go to zero. Hence this contract is like an insurance which is used for downside protection. This way, with the help of small premium, you avoided to sell your long-term holdings with a protection to drastic downside. So if we summarize a video, we learned about an overview of financial markets along with its different participants. Then we went through the categories of financial markets, through which we learned about various financial instruments and their relevance. Hope you would have enjoyed a video. Please hit a like button and subscribe to the channel. Also, do not forget to hit the bell icon. Thank you for watching.